Welcome back to the Wiser Money Show. Hey, this is the fourth quarter update for 2023. And this is your host, Ken Himmler. And welcome back. It's been a few months. The last one I did here was in July. But I have a very special show planned for you today because we're actually going to take a look back at some of the things that we talked about back in January. And we're going to look at where the economic map, the Econ map, has fallen. And it's going to be some pretty interesting stuff because, during the pandemic, when I started these video casts, if you would, these video updates, I made some predictions based upon some of the macroeconomics. I was about 85% right on with the timing, but that 15% primarily in housing and inflation was a little bit off. But all the other things, and listen, I'm not a genius. All I did was I tracked back, did a very deep dive into the into the Spanish flu epidemic and exactly what the psychology that happened back then. There was a couple things that fell into place that we didn't have back then, which is, COVID relief payments and child income credit and Social Security and Section 8 housing and welfare payments and food stamps and PPP for the business owners and ERC for the business owners and just on and on, rent abatement. So there's a lot of things that were a little different that made the landing a little easier than after the last pandemic. But here, let me get into today's show, and I'm going to show you exactly where we're going to cover today. We're going to cover inflation, interest rates, bonds, employment, stock market, and you might have been anticipating a update to the Econ map to version 3, but we are not going to update to version 3. So version 2 was done in January of 2023. Excuse me, got getting over this, a little cold, so I apologize. 2023, and I kept saying that based upon some factors, I may update this to a version 3. It has not been updated, and I'm going to show you why. We're still right on track, so there's no change. So let's get into this thing. Inflation, well, where do we stand? Well, the moving ball for the Fed, right? June to trailing 12 months flat, not really any difference. I mean, you see a little bit increase, a little bit decrease, a little bit increase, a little bit decrease. Not enough to move the needle. Food is pretty much now flattened out at the top, but housing, I'm going to say it's not going up, and I'll show you when we get to the housing section how some areas have actually gone down. If you remember, I predicted fourth quarter into first quarter of next year about a 20% drop in real estate. But I underpinned that with in certain areas. There are certain areas that I didn't believe that would have that kind of drop, but some of the boom areas like Boise, Idaho, or some places in Texas, or some places in Phoenix, and some places in the mountains, and some places definitely in Florida, some of those are seeing that push back, and I fully anticipate that 20% drop from the peak back to where it is somewhere reasonable. Now, interest rates are going to make a little bit of a difference, but energy through the ceiling. Why? Well, we have OPEC doing their little smack and run tactics. Listen, it's funny. I was watching this video, and this goes back to 2012. And we were on the way to a vacation, and we were in LA. And for some reason, there was a video of us filling up. I don't know why, but there was the gas station sign there. And gas was at $5 a gallon, over $5 a gallon. So here we are, 10 years later, and it's just this what I call the smack and run. If you looked at what OPEC said, they said that they need to build up their infrastructure. Oh, they're building some multi-trillion dollar city. It's just enough is not enough for them, I guess. And so what they do is they hedge by changing the price and the supply and demand to change the price of the oil, right? And what they do is they smack us around a little bit, and then what happens is we all start to come back a little bit, and we don't spend as much in oil, and we reduce the amount of the demand, and they've got more supply. Well, then they bring it down. It's just what I call the smack and run. They run away once we start reducing our usage. It's never going to change unless our government changes. Biden administration has no plan to go domestic. It's farthest thing in their world, right? Mortgage rates, 22-year high. That's a pretty big high. Well, let's talk about where interest rates are. Mortgage rates, highest in 22 years. The House of Representatives is now attempting to get rid of the CPB. CPB is the Consumer Protection Bureau. You know, I've read all the details on this. I don't think I'm qualified enough to give you an opinion whether they should or they shouldn't. To me, some of the things that the CPB has done, like pinged Wells Fargo. I mean, we were part of that whole Wells Fargo opening up accounts and you didn't even authorize it. Wells Fargo and Bank of America just charging you fees, and you got to sit there and track them every day, and they got penalized for that. I don't know if that'll ever stop them. But on the flip side, the other argument is they are reducing the amount of growth in the banking sector and the financial sector. And those massive penalties just are passed on to the consumer. I don't know. I don't know enough about how it works, but I do know that the opinion is that if they reduce the CPP's power, because they have unlimited power at this point, they can do whatever they want to do, whoever they want to do it. And here's what's interesting. They have a cap of $750 million. They spent $672 million in their agency, but apparently there's no oversight of the oversight. So I don't know. I just do know that if they were reduced or their power was at least prevented a little bit, then the opinion is that the banks could operate at a lower cost margin. I don't know if that would actually happen. I don't know if that would change interest rates. But listen, Feds, they're not going to tame inflation rate while free money's handing out. Listen, when I started this thing 3 years ago and they started handing out money, I said back then, just watch out, because here we are back in the roaring 20s again. And when people got out of the pandemic in the 20s, they went and spent everything that they could. They mortgaged up, they gambled, they drank, they did, all kinds of crazy stuff. Cars were just out and people started traveling the country. Sound familiar, right? They wanted to get out to nature, so everybody went and bought automobiles on loans. And when the stock market fell apart, everybody started stepping back and going, hey, we have all this debt. Then they took cars and they took houses, and therein lies the Great Depression, right? Started in 1929. So I said that, our psychology is looking the same way, and it tracked that it did. And what was happening is the government just kept giving out free money for this, free money for that. I mean, there's a neighborhood somewhere in Chicago that I read about that is literally giving not a neighborhood, let me correct that. It's actually a community that's giving every resident $25,000. It's supposed to be for home improvements, but there's no limit on it. So what are they going to do? They're going to buy Domino's pizza and go out to dinner and game. You have the Biden situation where they're going to eliminate the student loan debt, which I completely disagreed with. And when asked, over 70% of all the people that said, what would you do with your money if you got your loan forgiven? They said pizza, going out to dinner, travel. It wasn't to support themselves. So anyway, we anticipate from everything that we have put together that the COVID, and I'm wrapping a lot of stuff into this, right? It's not just COVID, but it's all this free money that the government has been giving away for the last 3 years. That's fully expected to run out somewhere in December. They were anticipating in September, and there's still some reserve based upon the average savings per capita versus the average debt per capita. But if you run it out to December, it's really going to bleed those people dry that got all that free money. They were just spending what they wanted to spend. And again, all that free money also had a huge, huge impact on the workforce and the labor force. But as we're seeing right now, repossession rates on automobiles and on housing is the highest it's been. It's the fastest growth that it's been since 2008. So we are over that little curve that I talked about back in 2020. So let's take a look at housing. But before I get to the punchline here, I actually want to tell you something. This is what I put out at the end of 2022. And let me explain what this says. In 2019, in the U.S., the median home was $274,000. The average mortgage interest rate was 3.17, which consumed at that time 15.7% of the average income. Qualifying income to get that house is $50,592. So the affordability index was 159 at that time. Now, going into 2022, here's what's actually happened. This is at the end. This is what I produced at the end. The average house went up to $414,000. Mortgage rates went up to 5.31. which consumed 24.4%. Now, in January, I was anticipating, this is what I wrote. This is actually right out of the January economic update that I did. It said the expectation is a 20% drop in the fourth quarter 2023 and first quarter 2024. Okay, just ran the numbers this morning. Here's what's interesting, and I got to show you something that's very unique, okay? But it doesn't tell us the whole story, and I'll fill it in. Just ran it, and now we're up to $410,000 as or down to $410,000 as the median home, but the mortgage rate went up to 710%, which is now consuming 42.1% of the average income. So here's what's interesting. The average income has gone up with inflation. Social Security has gone up with inflation, but now the qualifying income is $98,000. Now, the affordability index, because income eked up just a little bit, has gone up to 107 because the value has dropped just a little bit. But what this is saying to me is, from a macroeconomic standpoint, is we still have a long way to go for the market, the real estate market, to drop. I am still standing by this, and we've already seen this happen in some of those select markets that I started off telling you this at the beginning of today's show. But I think in a lot more markets, we're going to see that 20% drop by the end of the fourth quarter. All right, let's talk about housing and supply chain, because a lot of what we do with building can reduce the price. So the more buildings that are out there, the labor goes down, the supply cost goes down. We have more housing, more to choose from. It's more of a buyer's market than it is a seller's market, and the prices go down. Okay, so the supply chain has partially restored. Let me explain. A lot of materials have been restored. As an example, right now, there's actually an excess of steel supply. So if you're building a steel home, or if you're building, cars or whatever it is, there's actually an excess of it. Rare earth material shortage, though. So depending upon what kind of car you might be buying. It also might be if you're doing any kind of solar in your house, if you're doing battery backups in your house, if you're doing that kind of stuff. So mortgage rates right now have caused what I call the golden handcuffs on inventory. Because in looking across the board is why prices have not dropped enough. Well, number one is, if you would have taken a 3 to 3.5% mortgage, and let's say that was 3 years ago or 4 years ago, and you're locked in and you want to sell your house, you want to move, you want to do whatever. Well, it's going to be tough because you're now going to have to go get a 7% mortgage. And here's some of the pressure that's going to be put on people. So we believed back in 2020, 2021, this whole work from home thing would stay forever. It hasn't. A lot, if not most, of the major companies are mandating return to work, even if it's 3 days a week. There's one company out there that hired 800 people, and they 50% of them quit when they required a return to work. And one of the reasons is that a lot of these people that bought remotely, or they were working remotely, well, they might have had an office in New York City, but they bought a house in Montana. And you can't return to work unless you move to Montana. Well, they don't want to return to Montana. So they just quit their job. And this will have a positive effect. I know that for a lot of families, a lot of people, the pressure of losing their income is going to have a negative effect. But as a whole, I'm talking about macroeconomics, our country, our financial system, a massive amount of layoffs and people quitting and people unemployed would actually be good. It would reduce inflation. People would start getting a reality check of spending what they have instead of spending what the government is giving them. Because remember, what happened is when the government gave people a lot of free money, that empowered the workforce to go back to their employers and say, I don't have to work, so I want this kind of pay raise. I want these kind of benefits. It artificially created inflation. People were out there spending, and because of the supply and demand, prices raised artificially. So this was not a typical inflationary increase. This was a government-caused inflationary effect. So these things, such as housing, and maybe the push down of housing and people getting out of the golden handcuffs will be activated by layoffs. Lower interest rates will free up some of those golden handcuffs, and higher productivity, because the workforce is part of this problem. So we know that this is an indicator because bankruptcies right now are showing the fastest increase in filings in 10 years. It is, if you go back, everything's on YouTube, go back 3 years ago, look at some of the things that I built that model on, and they're coming true. Not exactly on the exact time, but I gave ranges, and they're pretty close to those ranges in timing. And the only thing that I did extend on the different versions is, again, as the government kept giving out money, I kept extending some of those economic indicators. Okay, before we go any further, I've had a lot of questions on, should I get out of bonds now? Should I buy bonds now? Or what happened to my bond value? Or what happened to my bond ETF value? So I'm going to take a little section right here, and I'm going to cut it out of today's economic update. And I want to give you an education on how bonds work and their inner workings, because they don't work like stocks. They're not related to the same fundamentals that stocks are, unless it's a convertible. We're not going to go there. But I want to show you exactly how a bond works, right? So you get a profit from a bond over time by the amount of interest that you collect. The more interest that you collect, the more return you get. So if you have a 30-year bond paying 4%, every year it's cranking out 4%. You can hold that bond till the full 30 years, or you can sell it. Now, selling it in the open market, because it's not mature yet, is very much like, it's not like a CD. You go buy a CD for a 2-year term or 3-year term, you can't sell it. You got to wait till you get out. On a CD, if you get out early because you want to, for whatever reason, you're going to pay an early withdrawal penalty. Now, look at bonds the same way. The difference is, if interest rates go up and you want to sell that bond before its maturity date, you're going to pay an early withdrawal penalty. It comes in the form of a reduction in the value of the bond. Now, on the flip side, if interest rates are at their highest peak in decades, and if you have the belief that the only way that interest rates are going to go is either level out for a little while and then drop, if you have a long-term bond and interest rates drop, and you want to get out of the bond, you don't pay an early withdrawal penalty. You can actually make money like a stock. It's actually a capital gain. And a lot of people say, well, what's the theory behind that? Well, listen, if you have a 5% 30-year bond, and now the new rates are paying 1%, you can do the math. Somebody is willing to give you more than par. Par just means maybe it's a $1,000 bond, because they may be willing to give you $1,100 or $1,200 or $1,400, because they know that if they hold that bond over a period of time, they're going to equal out to the same, if not greater, interest than what a new bond is issuing. So there's advantages and disadvantages when you buy bonds. Okay, the value of the bond increases or decreases based upon the increase or decrease in interest rates. So let's take a look at a comparison. Let's say that I go buy a 1-year treasury. And this is what everybody says. Well, why don't you just buy that 1-year treasury? You can get 5.25%, 5.5%. And if interest rates go down, there's no real increase or decrease in the value, because it's going to mature in 1 year, right? It's so minuscule that it's not even worth mentioning, because it's a 1-year maturity date. Now, if I go to a 30-year bond, here's where we get a little dicey, right? So I might only get 4.45%. For every 1% decrease in the Fed rates, I may have the potential between 5 and 10%. I've even seen more in the late 90s. Between 5 and 10% increase in the bond value. So let's think through that. I go buy a $1,000 30-year 5 or 4.45% bond. And let's say that interest rates go down a little bit. And now my $1,000 bond is worth $1,300. Now you might say, well, what do I care? I mean, it's just a short-term fluctuation in value. And if I don't really care about that, then what would I do? Well, you can sell portions of the bond, right? You can sell that to bring back to par. You could take some of the capital gains off the table. Now, you may not want to do that because you're getting a good rate on the whole thing. But I'm just saying there are options. You don't have to just stick in the bond, watch your statement that it goes up in value, and just sit there and say there's nothing I can do. It all depends upon what your financial plan is. Now, let's differ this with how a bond ETF works. It's different. Same, but different, right? All right, so a large bond, what an ETF is it's an exchange-traded fund. Let's just think of a better version of a mutual fund. Low to no fees, low to zero turnover, works on an index. You don't have a manager pulling levers like the Wizard of Oz. Just a lot of things that we won't get into, but just say that my preference is always an ETF over a mutual fund. So what this is, it's a large group of bonds. There might be 300 bonds to 3,000 bonds in this one ETF. It's a wrapper, it's a container, it's holding all these together. You own that diversified bucket for whatever the share price is of that ETF. So you have that large bucket, but see, here's the catch. They're not all the same bonds. There are different bonds. If it's corporate, it might be thousands of corporations. It might be all different kinds of issue dates and maturity dates if it's, say, a government bond, right? So when a bond matures, so I've got this bucket and a container, let's call it a bucket, and let's say I got 1,000 bonds in there. Let's say when one of those bonds matures, there's cash in that ETF. And see, that ETF's not allowed to hold on to that cash and just sit on it. So what do they got to do? They got to go buy a new bond. Now, if that ETF says that it's a 30-year ETF, guess what they got to go buy? A new 30-year ETF. Now, the problem is that when we look at what happens when a bond matures, it only matures at its face value. So even though maybe a year or two before the bond matures, there might be a gain or a loss. It doesn't matter when it matures. So let me explain why this matters. In the last 2 years, you might have had an ETF and you might have seen the value go down because interest rates went up. Well, inside that ETF, there's all these different bonds. And as they mature, they're maturing at face value, not at a loss. So this is why if you compared point to point, let's say that you bought a ETF 2 years ago versus what I just call a long bond. And here's what happens, or happened approximately. Average rates on a bond 2 years ago was about 3%. And that bond, it would have lost 10 to 20%. So, the problem is, I used to call this bond jail. So some people will say, well, I have a 30-year bond. It's paying me 3%. So why don't I just hold on to it? What's the big deal? Well, here's the big deal. 3% is not bad when inflation was 2, because you're making 1. But when inflation is 7 or 8, and you're stuck in that bond at 3, you might say, well, wait a minute, I'm losing 4% against inflation. So what am I going to do? Well, you can say, I'm going to sell that bond, I'm going to buy a new one. Who's going to want to buy your old 3% junky bond? Nobody. They will, but they're going to give you a discount. So instead of getting $1,000, you might get $850. You're going to take a 15% loss because somebody else is going to go, why would I want to pay $1,000 for a 3% bond at par? So that's how it works. And that's why if in the last 2 years you've seen interest rates go up, you've seen the value of a bond drop and the value of an ETF drop. But here's the catch. 2 years ago, an ETF also paid 3%. But depending upon the ETF during the last 2 years, a portion of their holdings have expired. Remember, because if you own one single bond versus an ETF that maybe owns 1,000 bonds with all varying maturity dates, within that group, some of those are going to be maturing and buying new bonds at higher rates. And they're going to mature without a loss because they mature at face value. So that's the upside of the ETF, because when rates decrease, the new bonds that the ETF holds will go up in value. So if I own that single bond, it's just going to return to par. That's all it's going to do, just go back to the 1,000. But within that ETF, because it's rotating those underlying securities, when interest rates come down, guess what? Some of those bonds are going to go up in value. That's the real key. So depending upon the vastness of the holdings of the ETF, the value has partially recovered. So if I compared 30-year long bond to long ETF, this long bond might have dropped 15%, whereas the ETF might drop 12, but now it's back to 10, and then it goes back to 8 in losses. As those bonds mature, the losses start to dissipate. So a lot of you have written into me and said, oh my gosh, my bond, my ETF safe bond has gone down 10%. Okay, that's exactly how it's supposed to work. When interest rates are going up, the bonds are starting to replace themselves, which is why we use the ETFs as opposed to one singular bond purchase. That's exactly how it works. And if you're following our 3-bucket strategy, what that value is day to day, month to month, quarter to quarter is irrelevant because we have timed those into dates of maturity for your cash flow. So it's exactly how it's supposed to work. And we tell everybody this, day one, expect that it doesn't matter what it is, what portion of that 3-bucket strategy, some portion will go up and some portion will go down. If we look in 2022, the stock market went up 28%. Bonds, nothing, flat, right? And then the stock market dropped 25%. And then all of a sudden, bonds dropped because interest rates went up. So you see this double whammy, but it's irrelevant because we're talking less than 1 year period of time. Okay, so now I got to bring one of my Buffettisms in. I read something about what Warren Buffett said at one of his meetings, and I hope I can get this right, because I thought it was one of the best ways to explain why people fail in their investments when they don't understand these time periods that are applied. So Warren has always been a holder of investments. He doesn't always hold everything. He's reduced Occidental, he's reduced Apple, increased Apple. He's done a lot of things where people think he just buys and holds forever. He doesn't. But he does have time periods that he looks at. And he doesn't buy anything. As he has stated, he has no intention on buying any stock that he would hold less than 10 years. Now if he's buying stuff, that would put him over 105 years old or something like that. But anyway, the goal is that you understand that things are long-term. Well, he said something that just stuck with me. He said people that invest and expect a shorter holding period than is reality is the same as a man wanting a baby in 30 days and thinking that he can impregnate 9 women and he can shorten the period of a baby to 30 days. Now, I thought about that, and only Warren Buffett could come up with something like that, but I thought that's actually a great way to explain it. You can't shorten the period. This is part of how it works. It's part of the plan. So hopefully that makes sense on the bonds. Let's get back to employment. So right now, this is a problem. Workforce productivity is at an all-time low, 55 to 60%. I would tell you, gosh, some of the things that I hear out there in the workplace, not our workplace, but general workplaces like service providers and hotels and airlines, my gosh, I don't know if I'd give it that much credit, maybe 40%. Average productivity is about 76, and average used to be up near 80 prior to the pandemic, but that pandemic has knocked that average way down. You know, you look at what's happened right now. You got the auto workers strike, the actors and writers strike, and I'm not here to judge them, but I'm here to say that when you give away free money, and now people build up their expectations of what they can spend. House, car, credit card, travel, whatever it is. And then you increase rates, but you don't increase the employment income at the same rate. Then there's this shortage. And a lot of these workers go back and go, that's my employer's fault. They're not paying me enough. And so then they strike. And so I'm not here to debate what's going on with that strike in either realm, but I am saying, isn't it coincidental that right now that we're at this bell curve of lowest productivity, highest interest rates, half the income of what inflation has gone up by, and now credit defaults starting to happen. All of a sudden, people need to make more money, and they're wanting their employers to do it, and it doesn't work that way. So, and you look at what the rates are. I mean, average across the country, inflation has increased incomes by about 3.5% at what, 7, 8? If you use the government's figures, if you use reality, it's probably 9%. People have gone into debt. And history has shown over and over and over again, the strikers are not going to win, meaning that they might get their concessions to go back to work, but they are still going to be in financial dire straits. They're going to be hurt. And it has nothing to do with our economy. It has nothing to do with our employers being greedy, because, when you look at the stock kind of represents if the companies are being greedy. And none of those three big automakers' stock has anything to do with greed. Otherwise, they would have done much better. And Warren Buffett has said he doesn't want to invest in anything where unions continually go back every time money is made. Because the minute you go back and you fixate in on labor costs, now when sales go down, which is going to happen with where we're at, how do these auto companies continue to make what is promised? So history has shown, because what do they do? Well, it's pretty simple. Companies will lay off people. They will consolidate. They will bring in technology. They'll use lean manufacturing, lean technologies. So if you ask me, what does this all mean for the stock market? Actually, it's good. It's really good. We go through this hurt period, and the companies lay a bunch of people off. They close down plants or offices, and they use better technology. They have the same amount of people doing more work, and they become more profitable. Happens every time. So don't fret about all these strikes. Don't fret about what's going to happen in the markets. This is a normal iteration or normal flow of our economic cycle, and it's actually at the best peak that we could be at. This is where we want to be. And to top that off, it is where most people have the most amount of fear. And when do we want to be in those markets? At the peak of that economic cycle, because that's where the fear begins. Now, nobody can predict where the bottom of that economic cycle hits, but if we're in and we have the 3-bucket strategy, we stay in. Let me give you some example of this. A lot of people are going, oh my gosh, the market's had the worst September in 3 years or something like that, since the March crash of the COVID. But let's take a look at this and really see how this fits into the 3-bucket strategy. If we look at the S&P 500, I'm not going to get into all the indexes because you can do that. I'm just going to show you real simply. Here's year to date. We're up 10.6% year to date. Now, some people might say, well, yes, but last year was such a bad year. Okay, let's look at 1 year trailing. That would be from today, because I ran this morning, to 1 year ago, today. We're up 15.02%. So when we see this market drop 400 points in one day on the Dow, everybody thinks Chicken Little, the sky is falling in. It's not. This is how it works. I would say that if this still freaks you out and you're in your 50s or 60s and you've watched this stuff the whole time, you got to look at the facts and look back and do your factual tracking and understand this is just normality. Right? Now, if I go back 5 years, wow, did we have a lot of stuff in 5 years, right? We had the pandemic, and we had the election, all this stuff that happened. 5 years, that S&P 500 is up 46.55%, right? Even if I break that backwards, what is that, 8, 7, 8, 9, about 9%, 5 years? Yeah, about 5. It's about 9%, right? 9% is not bad. At least that beat inflation on average for the last 5 years, right? So that's even after this last September. Now, let's look at the antithesis of this, because not the antithesis, but the other component. If you look at how we compile these portfolios and how the mixture is in that recipe, Part of those, the models are REITs and broken down by commercial, data, data storage, residential, land, cell towers, etc. You have bonds, you have treasuries, you have corporates, you have foreigns, and then within there you have short term, less than 5 years, intermediate term 5 to 10, long term 10 plus. So all of those have had that same effect. This is just recently within the last 10 months. If you look at what's happened with the treasuries, you can see there within just 2023, you can see the increase in the yield. So if the yield goes to 10.762 and you are holding a bond or even ETF, then the value of that has probably dropped 10 to 15%. And that's okay, as long as you have an ETF. If you have a bond, yeah, you're in bond jail. But I've never recommended owning individual long-term bonds. You can search my name and search all the presentations I've done on bond jail, is what I call it, because you're stuck. But if you're in the ETF and you're mixing that in the models with the buckets, then it's exactly where we expected it to be. So let's go back. I'm going to do this quick, because I know a lot of you have seen this many times, but those of you that are new viewers, you might not understand what the bucket strategy is. The bucket strategy is splitting up different types of investments based upon their volatility, reverse engineering the amount of cash flow that you need, and then placing a certain amount into each bucket. Now, you don't put it all in the first bucket going, well, I just don't know where the market's going to go. You put it in there to reverse engineer your cash flow. So here's how it works. There's 3 buckets. First bucket is based upon the first 5 years. Bucket 2 is 5 to 10. Bucket 3 is 10 plus. Bucket number 1, you put money markets, short-term bonds, TIPS, I-bonds. In bucket number 2, the 5 to 10, you put short, intermediate term corporate bonds, government bonds. You could put some preferreds and convertibles in there depending upon their rating and their maturity dates. And you can even, at the tail end of that 5 year, you can put large blue chip dividend stocks, right? Because you might not have to touch those for 8 to 9 years. And then finally, in the third bucket, which is the 10-year plus, is stocks, bonds, real estate, private equity, and covered calls. So how it works is if you want to develop a cash flow, the amount that we place into the first bucket is paid out over the first 5 years. Bucket 2 and bucket 3 just sit there. They don't do anything. They're just going to grow because they're going to be volatile. Now, when bucket number 1 runs out, bucket number 2 has grown because you let it sit there for 5 years. You turned off the TV, you turned off the internet, you turned off the news. Yeah, right. That'll never happen. And what you've done is you've said, hey, what I'm going to do is I'm just going to wait for 5 years. And in the 5th year, I'm going to start to ladder in some of my portfolio to pay me out over the next 5 years because bucket 1's gone. Now remember, we haven't touched bucket 3. Bucket 3 is sitting there. Now bucket 3 is the 10 to 25% volatility, right? Remember, that's real estate, stock market, covered calls, private equity, those things that are really bouncing all over the place. And we don't care about it until the 10th year. That's when we care about it. Because in the 10th year, bucket number 2 has run out. Because remember, bucket 1 paid you from years 1 through 5, bucket 2 from 5 to 10. And we've been sitting on bucket number 3 for 10 years. And now, if you make it that long, then we just take that bucket number 3 and we reapply it back amongst the 3 buckets. Now, that system will work very well while you're retired or in what we call the distribution phase. Well, what if you are in the accumulation phase? Don't use that strategy which I just showed you. It's just the opposite, actually. If you're in the accumulation stage, what you want to do is load up bucket 3, and you don't start distributing or paying out, meaning you don't divide the buckets up, until about 2 to 3 years before physical retirement, before you switch from the accumulation stage to the distribution phase. But if you are in the distribution phase, you are going to move money, cash flow, from the left to the right. Very simple, but it is important to know that this bucket strategy does not apply to you if you are in the distribution phase and more than 3 years away from retirement. Okay? Now, when we talk about how people make mistakes in the market, well, I'm going to do this because I see this snake rearing its ugly head again. People will lose money in the markets. It doesn't matter what market it is. It's real estate, it's bonds, it's stocks. It's because, well, I'm going to sell because that went down. It's the same thing with bonds. I'm getting people going, maybe I should get out of my bonds. They're down 10%. No, it's exactly what was planned. They're going to mature and they're going to catch up, and just leave it in the plan, right? It's like, I don't know, getting on a road and maybe you've mapped out your vacation from point A to point B. And all of a sudden, on one road there's construction and you're tied up. Maybe you have a delay of 30 minutes. Do you just take the first dirt road because you say, I'm not going to wait for that. I'm just going to go around it. People do. It's funny because Julie and I were driving the other day, and I've always said I should do something like this because it just shows the psychology. I think that there's a direct correlation with the way that people drive and how well they invest their money. Because we followed this person who was driving like a complete crazy person, putting everybody at risk, and sure enough, we come up to the same stoplight as they did. They take off from that stoplight going green, ripping out of there, putting everybody at risk, boom, next stoplight, there they are again. That kind of mentality does not work in driving, and it doesn't work in investing. So we've never been a part of that mentality. And, that mentality is also motivated a lot by the media. Sell now, buy now, do this now, do that now. I always tell everybody, remember what Bill Ackman did back in the pandemic. He bought $25 million of shorts, and he claimed the world was coming to an end. The market dumped because he's a well-known guy in the hedge fund area. And he cashed out and made $4.5 billion on those shorts. So don't always trust what the market gurus are telling you, right? So you also have to make sure that you're not wasting your cash. If you've got long bonds, you're making 3%, inflation 7%, yeah, you're losing 4%. If you've got money in money markets making 1, 2, 3, or 4, and inflation 7%, yeah, you're losing money. You got to get that money working. And then taxes. That is going to be the biggest financial security killer. And you just need to focus on reducing your taxes. All right, key indicator changes. New sale homes down 25% this October. Happened last October too. Now, it's not 25. 25 equals 50, right? Because if I take 100 down to 75 and then 25 off that is not another 25. So it does follow that flu pandemic though. All right, mortgage interest rates increased to 7%, but that's not the only picture, right? Because when you have mortgage rates increased to 7%, you have inflated property prices. You also have an inflated property tax and an inflated insurance. And so those are killers in the real estate market. And it sometimes makes it unaffordable for people to keep their incomes or to keep their houses. And then if you start talking about mass layoffs and income reductions, we will see an adjustment to the real estate market. Okay? Here's our Econ map. Now, I'm going to just bring it up because we're running out of time. But I want to show you something. And this is exactly what I produced in January of 2023. And after further research and review, I'm not making any changes. If you look, we're tracked exactly on with 10 months ago where I built this Econ map, right? Real estate starting to go down, finally. Inflation went up, right? Peaked out at when? May, June, right? And then we're starting to see inflation come down. Interest rates continue to go up until that peak of inflation. Now we're seeing a leveling. Employment, productivity, still on the downtrend. Stock market went up. We had a rough time when the Russians invaded Ukraine back in the first quarter of 2022. Leveled out. Now we're back on the rise again. Don't pay attention to a 30-day adjustment within the markets, right? That's only September of 2023. We are right on track. I am not changing versions from January of 2023. I'm still on version 2. I do believe this is going to continue to play out. What are our actions? Well, number one, you got Secure Act 2.0. You have to make some changes in your trust. You have the debt per capita has gone up, And so that is rounding out that Econ map. So one of the key indicators is watch that debt ratio per capita, watch interest rates as they apply to savings rates and reserve decreases. Recalculate your cash flows. If you're working with your financial planner, jump back into eMoney, have them do another cash flow calculation. If that makes you feel secure so you can see exactly how it fits into the 3 buckets, do it. Now, in March of this year, 2023, we did a rebalance, and what we did was we pulled a lot of our longer maturities back a little bit, and we changed our bond allocations, and we took some money out of other countries. We took it out of Mexico, we took it out of China, we took it out of Russia, we took it out of a lot of different countries that we felt were better domesticated. And now what we're going to do is we're going to go a little bit longer. It's going to take a little bit more time, but we're going to smooth in or ease into much longer term bond positions. This will do 2 things. This will give us a higher interest rate, and it will also give us the potential or the opportunity to make a capital gain when and if those rates start to come down, which I do believe that they will. I do believe that at the end of the first quarter of 2024 into the second quarter, we will start to see an easing of rates. When that happens, the market's going to blow through the stock market is going to blow through the ceiling. We're going to start to see an increase in the bonds in the long bond value. All right. Hopefully that helped you out, catching you up to date. If you haven't subscribed to our YouTube channel, you can just Google H&H Financial Center. Hit subscribe. By the way, if you have also subscribed to our other YouTube channel, which was called the Wiser Money channel, Wiser Retire, we have now changed that to Wiser Wealth Academy. We're in the process of rebranding that, and there will be some educational classes that you can take on that site. So without further ado, I hope that helped everybody out, and enjoy your weekend. We will do an update probably end of December to kind of recap how accurate we were on the year. But right now we're tracking over 85% as far as where we started at the beginning of the year to where we are today. All right, have a good day.